Moving on, we're moving actually into chapter 5 and starting with current assets. And the idea is that why is there so much emphasis on current assets is because it is the most liquid asset. It's basically what you can use to pay your bills. It's also, in other words, like cash is where you have your internal controls to make sure the business is operating smoothly and efficiently, and you have processes in place for smooth operations, great controls, meeting compliance, and preventing fraud, which is all important business practices. So cash includes basically every type of currency that is on hand, and cash equivalents, very important, includes securities as well as money markets and commercial paper. Basically, anything that's like short term that matures in less than 3 months can be included as cash. Cash management goals, essentially, we want to make sure that we invest in the cash is being invested, that there's adequate amount to pay bills, avoiding idle cash, avoiding large amounts of cash. Obviously, we talked about that. That could prevent growth, or you would have so many assets that are not generating income, so the assets actually are not being used efficiently, and also need to have controls in place to prevent theft and fraud so that the cash is secure. And what are the internal controls? Basically, this is where compliance comes in, reporting, segregation of duties, making sure it's not that easy to write out big checks. You may need two sign-offs. Make sure that things are moving efficiently. And bank reconciliations. This is the biggest control that companies do, is bank reconciliation. So basically, if something is missing, you know about it right away so it doesn't become an error. This is a very technical accounting thing. We will get back to it to learn about how to do it on a deeper level, but it is a very important control to have. I want to do the lecture first and then come back to it as an example. Um, Moving on to what are short-term marketable securities. This is also a capital asset. This is basically, think about anything that is a tradable stock or bond, something that has a market, public securities or liquid bonds, something that can be converted. The other big thing that we're going to be going through is accounts receivable. Now, accounts receivable is an account that we all know what that is technically, and as the journal entry we looked at it, but how do you work with accounts receivable when you have an uncollectible account? This is something that could be past due, and what you do is you have an expense called bad debt expense and what is called an allowance for bad debts. And this is basically something that the allowance for bad debts is a contra asset account that reduces the balance of the account receivable at the end of every period. And the bad debt expense appears as basically an expense on the income statement. And this is something that we're going to do an example about as well. But basically, how do you estimate the bad debt expense? Is basically it's either a percent of sales or you age the receivables, and the older they are, the more likely that there will be a bad debt expense. And this is the net realizable value of your account receivable, is basically how much is expected to be collected. It's very standard in every industry. A certain amount is basically written off. And when you write something off, you remove it from the receivable, and you remove it from the allowance, and it goes into essentially, that's it. You don't have it in the allowance anymore. It's essentially gone because you don't ever expect to collect it. In other words, it's never will be collected, and you just kind of have already recorded it as an expense, and now it just moves out of there. And essentially, this is the piece that we wanted to go through. We'll continue with this chapter next week as well.